While everyone panicked about Trump's tariff threats and Powell's legal troubles this week, something far more exploitable was happening beneath the surface. The Russell 2000 just posted its 11th straight session of outperforming the S&P 500, the longest streak since June 2008. Gold hit all-time highs above $4,600, and despite solid earnings from companies like Taiwan Semiconductor and Goldman Sachs, the market sold off anyway. This wasn't chaos. This was human psychology creating systematic opportunities for those who understand the patterns. Most investors see this week's action as confusing or scary. I see it as predictable. When markets reach all-time highs and then face political uncertainty, humans always respond the same way. They abandon their winners, chase safety, and create mispricings that disciplined investors can exploit. Today, I'm going to show you exactly how this week's rotation reveals 3 specific patterns you can use to position yourself ahead of the crowd. The human layer tells us everything we need to know. Investors demonstrated classic recency bias, treating last week's records as anchors while experiencing acute loss aversion from geopolitical noise. The rotation from megacap tech into small caps wasn't strategic. It was herding behavior in reverse. After 3 years of narrow leadership, participants finally acknowledged that crowded trades carry asymmetric downside when sentiment shifts. This is the endowment effect in action. Banks like JP Morgan beat estimates but still sold off because investors holding financial stocks at elevated valuations demanded perfection. Even modest misses triggered immediate punishment despite solid fundamentals. The precious metals surge wasn't speculation, it was insurance buying at scale. Gold breaking 4,600 represents a collective admission that traditional safe havens like treasuries and the dollar have become contaminated by political risk. Meanwhile, the semiconductor rally on Taiwan Semi's guidance showed confirmation bias at work. Investors desperately sought validation that the AI build-out remains intact, willing to extrapolate a single data point into a multi-year thesis. Now here's what the system layer reveals. The market absorbed contradictory inputs and produced one coherent output, risk-off positioning disguised as rotation. The S&P's inability to hold gains despite strong manufacturing data and benign inflation showed that fundamentals had been temporarily subordinated to political variables. The Russell's 11-session streak wasn't economic optimism. It was mechanical rebalancing as strategies reduced exposure to crowded positions. The bond market exposed a critical shift. Treasury yields rising while stocks fell, and the dollar weakened indicated a breakdown in traditional correlations. This was driven by concerns over fiscal sustainability and central bank independence. The 30-year yield climbing to nearly 5% while geopolitical tensions escalated suggested duration risk was being repriced independent of growth expectations. Foreign holders are reassessing their willingness to finance U.S. deficits at current rates. The commodity complex told a bifurcated story. Energy rallied despite demand concerns, reflecting supply-side politics. Gold and silver's simultaneous surge represented structural buying from institutions treating precious metals as uncorrelated assets. The earnings season's early results revealed valuation compression. Banks beating estimates but selling off showed multiples had expanded beyond what fundamentals could support. But here's the stoic interpretation that changes everything. This week's behavior was neither irrational nor surprising. It was the natural consequence of elevated valuations meeting elevated uncertainty. Prices reflect not reality but the collective interpretation of reality filtered through participant biases. The rotation wasn't predicting recession, it was simply repricing the cost of certainty. The small cap rally wasn't a signal to chase, it was a signal that positioning had become extreme and mechanical rebalancing was underway. The Stoic doesn't interpret mean reversion as a new trend, but as correction of an old imbalance. The defense sector's surge on budget proposals wasn't an investment thesis but a policy trade, subject to reversal when political winds shift. The precious metals breakout wasn't predicting collapse but acknowledging fragility. Gold rises not because the system is failing but because participants believe it might fail. That belief alone drives flows. The bond market's repricing wasn't forecasting inflation but recognizing that fiscal discipline has eroded. The earnings confirmed what we already knew. Companies are executing and the economy is growing. The market's negative reaction to solid results wasn't rejecting fundamentals, but recalibrating expectations. When valuations expand beyond justification, even good news becomes insufficient. This week changed nothing fundamental. It revealed what was always true. Uncertainty is permanent, volatility is cyclical, and discipline is the only sustainable edge. You cannot control Trump's threats or Powell's troubles. You can control your position sizing, political risk exposure, and willingness to act when others are paralyzed. Subscribe if you value systematic thinking over emotional reactions, and grab the complete framework in the description below.